I would like to welcome to the stage next a couple of people who probably need no introduction for the Fireside Chat. One, Mr. Anthony Pompliano. He is the founding partner at Morgan Creek Digital. You also may know him from his podcast, Off the Chain. And I'd also like to welcome to the stage Mr. Vincent Molinari and Mark Smith. Please, everybody give them a warm welcome and a round of applause.
Always wanted
I think
theme
we're supposed
music,
to sit underneath our names here.
Oh, yeah?
Perfect. By the way, I pulled a trick on these guys. I told them to get dressed up, and then I didn't, so that sucks for them. But I can't see anybody. Oh, I see a lot of phones. Cool. Thank you guys for doing this. Can you guys hear me?
Are we on? Yeah. I can
Are
hear
we
you.
on?
We're
Hello?
good.
Hello?
A little bit.
Yeah? All right. Is everyone paying attention? Why are you guys leaving? Don't leave. Come back. No, yeah. The guys at the door, come back. You have to listen to this. This is important. All right. We're supposed to talk about digital assets and tokenized securities and a bunch of other important stuff, but I feel like you guys sit out there and you just hear the same thing over and over and over again, and you probably could regurgitate all of that back better than we could say it. So instead, I want to flip it on its head and start with asking you two, what are the things that people are talking about that they shouldn't because they're just not nearly as important as people think they are? Like, what are the areas that we're too focused on that don't have as much importance as people think?
Great jumping off point. And thanks for having me here, Pomp, and Mike and Jason. Thanks for organizing such a great event. And of course, everybody for coming out and listening to all these great conversations. So yeah, I'll quote our chief issuance officer, Bernard Vanderleer, who kind of said to us, you know, this is not about being tech fin, this is about being fintech. So I think we've had a dramatic overemphasis on the technology when it comes to the world of securities. So I think we need a level setting of what's actually happening here. And we can dive into more details, but I'd say that's a pain point that I think is overstated in the marketplace, where I think we'll recognize that the technology is way more advanced in its capabilities than where our regulatory frameworks are. So I think it's a recognition of regulation first, what we have to speak about.
Okay.
Yeah, and we spend a lot of time in this ecosystem talking about decentralization and utility, and there's this overall shared delusion. How many people in here have used a digital asset for anything other than trading? That's a pretty small number. Who in here believes that the majority of these are decentralized? Very good. So these are two big shared delusions that we talk about often, and it's really somewhat irrelevant. This is a new tool set for finance specifically. This is a new way in which we can improve and enable the systems that exist to operate in a better way. When you think about the idea of security tokens, I don't even like the thought of token. Tokenization leaves us behind. We've tokenized assets a long time ago. Assets have been digital for quite some time. Most of the assets that you deal with on a daily basis are book entry. What we're doing is we're creating a new paradigm in which you can regather property right ownership, where you can automate value, and where you can set up the ability for new marketplaces to do things they haven't been able to do previously. But this is an enablement and an empowerment. This isn't some radical disruption that takes us in a completely different direction. And I think talking about that wastes a lot of time and energy when we should be focused on solving the real problems that exist.
So I think, can you guys?
Hello?
Oh, all right. I think one of the things you hear a lot in this space is which blockchain is it going to get built on, right, to your point. What are the banks going to do in terms of, are they going to use public chains, private chains, and we're seeing different strategies. How important is that stuff, right? Like, does it actually matter, or is that more of a bottom-up approach and we should just be looking at it top-down in terms of how do we solve the user experience and then the technology gets figured out from there?
Well, I'll jump in. I'll say it's a top-down approach. And I'll harken back to perhaps two of our earlier speakers with Lawrence Johnson from Morningstar, and I'll have to dub him going forward the James Bond of digital assets after his presentation this morning. But he talked about two key things, right? Large buckets of existing assets that aren't trading or have lack of transparency or lack of information symmetry. And then the other side, we have lots of noise in the space right now. And Travis talked earlier about this is an evolution and not a revolution within financial services. So if we level set there for a moment, we talked a little bit about this right beforehand. What are the impediments, right? We've got this technology ability that's well in advance of our regulation. We have regulation that needs modernization for certain aspects, but the reality is, if we're talking about securities, and this we're talking about a security as a digital asset, we have the 33-34 Act and the Jobs Act. There's clear runway to go in and operate on existing assets. The lags, I think, that are really hurting this market is people aren't being intellectually honest in what's happening. So we have this huge drag of credibility from the ICO bandits, as I would say, and whether naivety or bad actors who have left global investors holding the bag in many, many assets. So that black eye is hurting adoption. And then I'd say after that, you have what I'll call the posers that are creating a technology who haven't spent a day in financial services, and all of a sudden this is a regulatory compliance solution. And I scratch my head and say, well, how is this market going to move forward by folks who haven't experienced market infrastructure? So I think if we look at all of those converging, it's a top-down approach to say, how do we move this? And it's a migration now to institutional acceptance. And I think that's the big story here. Once you have the regulatory frameworks and the approval sets, you can remove counterparty risk. You can have your AML KYC, and you can transact in large assets, again, whether they're asset-backed, debt instruments, we can go on and on, new and innovative ways around creating product that comes out of real estate or patent portfolios, and put it on a pathway to secondary liquidity. You change the very nature of that instrument. And now, take things like S&P CUSIP that we've done and adopted. You begin to create standards, best practice, and access to information and data on these instruments previously not had. So I think you then you can have the conversation, is it public chain or private chain? And no question for us, it is private permission. These are securities. You need folks who are ATSs, broker-dealers, clearance, settlement, custodian, in order to effectuate that process.
So I will take the devil's advocate approach.
I was hoping you would.
Just because it makes it more fun.
Yeah.
And I will not tip my hand on what I actually believe, but I think the devil's advocate would say Uber was started and no one at the company had ever driven a taxi. Airbnb was started, no one had ever operated a hotel. And actually what those companies did was they broke the law, right, and broke the rules, and they created a new paradigm. Why is that not possible to happen here? Why is it that the lack of experience is an advantage? And then also, why would you disagree with the idea that maybe the rules are dumb and doing it a different way will force the rules to change?
Yeah. No,
There's
please.
nothing wrong.
I got them excited now.
There is nothing wrong with identifying rules that are dumb, but if you do, then it's incumbent upon you to change them, right? Not to break those rules and have some shared delusion that you're not breaking rules because you've just renamed something that we already know what it is, right? Calling something a utility token when everybody knows it's security doesn't make it a security. So, at Symbiont, we changed the law in Delaware. Why? Because we weren't sure that you could legally use a blockchain as a share registry. So rather than guessing, we changed the law. This is possible, right? Uber, when you're not dealing with someone's money, you're not dealing with almost 100 years of regulation. What most people don't realize, the shenanigans that are happening in this space happened way back in the Great Depression, before that in the crash, right? We call it wire fraud because the criminals figured out that the wire system was easier to steal money from than going into the bank. So when you think about finance and healthcare, those are two places where hobbyists should not be involved. You need to understand these markets. You need to understand them deeply in order to be able to find a way to enable and empower the participants. When we think about the enabling that we're doing here, when you ask about institutions, waiting for institutions from a sell-side service provider standpoint is silly because they're caught in the innovator's dilemma. They don't think the system is broken because they dominate the system. So when you think about what we're trying to accomplish here with this transition into smart securities that are native to a blockchain, that are automated, that empower the issuer, that empower the investor, right? That is a huge shift, right? We're moving the power to where it belongs, the customer. Too long, the customer, the buy side, the investor, has been a slave to the sell side and what services they want to provide. The only way we went from open outcry to electronic trading was to have outsiders, day traders, who understood the market to build technology that would replace those who were there caught in the innovator's dilemma. We're in that exact same place today, except for the change is an order of magnitude larger than the change that occurred due to matching.
So I think part of this is there's a big conversation around the technology, right? So if you think of today, many assets are electronic QSIPs, and there's this belief that they can go to become digitally native assets. One of the things that I think gets forgotten is there's a lot of humans involved, right? So software engineers are going to write code. That code's either going to support electronic trading, digital trading. It's going to be permissioned, non-permissioned, whatever it is, public, private. But then we get to these bankers, right? And the service providers and the individuals who are providing intellectual capital, right? They're usually not technology driven. It's usually much more like an investment banker or underwriter, et cetera. I think a technologist view would be, oh, we can just automate them away, right? Maybe. There's a lot of people in the finance world who say there's no chance you can automate away a banker, an underwriter, et cetera. Where do we end up if we do get to tokenized securities and mass adoption, right? Is there a place for humans in this kind of semi-automated or automated system? Or is there actually a path towards all of those service providers and kind of intellectual capital providers getting automated away?
Again, I think it goes back to evolution, and I'll jump back to your previous question first. So much different than technology solutions coming out that disrupt, right? Break glass, run fast, beg for forgiveness later. We have securities laws for the protection of investors. So we cannot break things and ask for forgiveness. That's called go to jail, right? And I don't say that flippantly. I think the entire marketplace recognized these opportunities, and the marketplace largely got a free pass from the SEC on the 21A report, the Dow report, that said, okay, maybe there was lack of clarity. We're calling these all securities. So that naivety is over with. And I think there is absolutely, we wouldn't be having this conversation if it wasn't for brilliant cryptologists who started this process, right? And it doesn't mean that we shouldn't have innovators in the process. But when we're baking certain things and holding out standards to investors as the protections, and you're not regulated, that's against the grain. Could that change? Yeah, absolutely. And it's why Templum's advocated so strongly. We've had over 24 petitions for rule change, comment letters, 3 sets of congressional testimony, blah, 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 Senate. All of that to move the needle and modernize these very securities laws that intersect with the most innovative technologies, but doing it responsibly. We can't act by saying we applied for a broker-dealer, or we have a pending ATS, therefore we can do this. So I think that's for holistic, long-term growth in a responsible way. And 10 years from now, 20 years, maybe there's not humans. I don't think so. I think, the big joke when we talk about all this stuff of consensus and decentralization, my goodness, as far as I look at many of these alternative currencies, they're pretty damn centralized. So I think if we're, again, intellectually honest with this is a process that will continue to change. What we think today, we weren't thinking 2 years ago and a year ago. And I think that's why the migration to institutions is really becoming the standard bearer, because we do have these huge chunky assets, $3 trillion of annual issuances in the United States of unregistered securities instruments, relative to about 1.7, 1.8 trillion of our public markets. We lack infrastructure for that marketplace. It is the perfect use case to start this evolution, right? How do we have transparency for investors? How do we have symmetry of information? Perhaps audit trails for the first time. And then secondary liquidity. Sounds kind of familiar. We've seen this story before in new product creation that evolves to tradable assets.
When you think about technological innovation, there are always naysayers. We go all the way back to the Industrial Revolution and the Luddites, who went and broke machines because they believed those machines would end human work forever. That's not true. As a matter of fact, it's never been true when there's been an evolution or an innovation that we've lost human participation. Actually, human participation tends to increase during those periods. we do have a good analog here in financial markets. We can look at the evolution of the matching engine and what that did to marketplaces. You would imagine today we would have one singular marketplace in which you trade US equities, but instead we have almost 60 places in which you can trade, right? We expanded the number of opportunities when we added technology. Firms that were market makers and specialists, they didn't disappear. They became direct market access trading vehicles that provided access for hedge funds and new high-frequency traders to enter the marketplace. Markets expanded, spreads contracted, cost of trading went down. More jobs were created, not less. So this is the same type of thing. We will see this again in this ecosystem. There'll be those who try to resist it. There'll be those who embrace it. Those who embrace it will be rewarded over a long period of time. And those who resist it will eventually either die out or they'll enable themselves to adapt and create a new business model for new alpha using these tools. And we see this all the time, and it will continue to happen.
So I'm going to continue being the devil's advocate for a minute. If you were to look at the non-security side, right, for sure, light years ahead of everything else is Bitcoin in terms of adoption, transaction volume, et cetera. And then there's everything else. Bitcoin, when it's taken, right, so tens of millions of people have use it or have wallets. It did $400 billion of on-chain transaction settlement last year. This year, one day, it's $7 billion, right? So this thing's being used by a lot of people globally. It has more usage than Venmo, PayPal, Apple Pay, et cetera. These products that we think of as really big, popular things. This fully decentralized, fully uncontrolled thing has grown very quickly. And you could argue that Bitcoin has grown outside the system, right? It wasn't an evolution. It was a complete revolution, completely different system, completely different monetary schedule. When we take the analog back to the securities world, is it the rules that prevent a complete disruption, or is there something else that forces us to evolve it? Because I agree with you that we are seeing an evolution, but what's forcing it to be an evolution rather than the revolution?
I think it's the existing ecosystem, right? There are massive walled gardens and barriers in the financial marketplace. Right? Bitcoin was allowed to be kind of incubated quietly, right? Several years of it growing without this big attention, right? Without these horrible centralized marketplaces damaging Bitcoin. I think the explosion of these over-the-counter marketplaces has actually hurt Bitcoin's growth. It doesn't allow it to execute its promise, which is this beautiful way to move value anonymously from one responsible adult to another, one responsible person to another, without having to get permission from someone in the middle. It was done very differently than the majority, actually everything else, right? And purposefully was left alone. I can remember back when WikiLeaks was considering allowing Bitcoin to be used for donations, and there was a reach out to the community that said, please don't do that. It's too early. We need to let this thing grow. The resistance is that when you run headlong into the existing financial marketplaces, you have way too much inertia. There's no will because most people are thinking about, I've got 5 years left in my career. Am I going to take a risk on Bitcoin or ride this out, right? So it has had its really interesting time to grow. I'm a huge believer in Bitcoin, and I view it extremely differently than anything else that exists in that ecosystem.
Yeah, again, I think if you parse it, it's legacy infrastructure and its regulation, Bitcoin expanding outside of that, certainly a wonderful use case and a market demand for it. I think what is a really interesting conversation, if we separate the world of securities, and that's where we operate, we're advocates for things that are going to job create, foster innovation. Is there a place for app development, affinity groups, fan base rewards? No question. But the moment you put those into a bucket of economics and anticipation of rate of return, it becomes a security. We advocate and we consult with Congressman Davidson on the Token Taxonomy Act. That's saying quite the opposite. Let's preempt all of these instruments. They're not securities and they don't comply with blue sky requirements. That's really forward-thinking and very innovative. It doesn't touch securities, but we think there's this place to foster that innovation. So I think, again, it goes back to being honest of what the instrument is actually doing, and if it is a security, under existing laws, we have to comply with it. And then the challenge where you can't compare, I don't think today, is the level of decentralization or globalization of Bitcoin is global regulations on intra-country. Makes it very difficult. So I do think it is, again, back to that evolution, and certainly cryptocurrency I'd put very much in the bucket of revolution.
So I always ask people, what is the one regulation that you would change or improve if you could? And given that you guys operate in that world, I'm hoping you have good answers.
I know immediately, right? I would immediately remove the depository eligible requirement, which causes every company.
Explain what that is first.
So the Depository Trust Corporation has a subsidiary called Seed & Co. And there is a rule that states if you are going to go public, you have to cede your property right ownership to this very opaque institution, which is, and create what's called depository eligible, which basically means we can take your ownership, turn it in, digitize it, right, inside the DTC, and then instead of giving you back your property, we're going to give you a contractual obligation of the DTC. How nice is that, right? You're going to pay to buy something. I'm going to buy a car, and then someone's going to take it away and say, whenever you want the car, come to me and you can drive it. Right? Would anybody do that? I certainly would not. But this is the way the security markets work. And there is a rule that says if you're going to go public, this is what you must do. So when you think about the context of what we're trying to accomplish here by having native digital securities solely custodied by a blockchain, we're returning property right ownership, right? If we did nothing else, that is massively powerful. And if a company decides to go public from private and they are promulgated inside this structure, and then they have to give that up, the private company has to give up the ability to know who their shareholders are, to communicate with those shareholders instantaneously, to have a complete audit trail of what that has happened since the inception of that particular security, to be able to vote. All these things go away the second they go public and cede their ownership rights to the DTC and Seed & Co. So getting rid of that depository eligible rule will open up the opportunity for private companies to go public and public companies to change their structure and give ownership back to their investors. That would be very powerful.
Well, I'd fully agree with Mark, and it's a wonderful question. It's part of our a core to our petition for rule change to the SEC in December of last year, is definition of custody, clearance, and settlement around these instruments. Without that, there's real challenge institutionally, and we have this real confusion in the marketplace. The SEC continues to ask for custody, right? When we talk about unregistered securities, we come back to the commission and say, oh, by the way, you're talking about a public company nomenclature. Let's start with that for custody. It doesn't exist for an unregistered security marketplace. There is no rule or requirement around custody for an unregistered security. To Mark's point, not one of these instruments are DTCC eligible, therefore they do not transact in the existing system. It's very much why we went after the unregistered marketplace, because of the need for infrastructure. So I think if we get clarity and we continue to advocate, we've created solutions. And again, is it needed today? We've baked in the transfer agent into our process. We're partnered with Symbiont, in case you didn't know. We get along quite well with Mark, and we share many of the same thoughts. So Symbiont's technology as an enterprise level blockchain solution is layered on top of Templum. That technology can handle everything that we need to do for all of these. However, we had to do redundancy because it made the regulators happy, and we put a transfer agent in. Why? Recorded ownership on a centralized database that the SEC oversees. As part of this evolution, that was a pain point that we solved. When we talk about custody, well, people are talking about custody, they don't even begin to understand what good control means in the eyes of the regulator. So how do we solve for this and continue to advocate? I think those are the big things that the marketplace needs to come together and unify around standards and advocacy so that we can move this space in a very meaningful way.
You guys are so on fire that they zoomed in on you and cut me out, just for the record. Look at their outfits. No, don't put me back up. I'm just going to keep everyone laughing.
This is the personality right
here. True or false question, you can't say anything other than true or false. Every stock, bond, currency, and commodity will be digitized in the next 10 years.
True.
False. Ooh. One true, one false. Why false?
I just look historically, right? You would imagine that all share transactions would be electronic today. They're not. We have about 85%. There's 50% that are done high touch, right? There are things that just require high touch. There are customers who want high touch. there will be some resistance, right? We use the 80-20 rule in almost everything, right? So somewhere between 80 and 90% will be there and 10% will remain.
So I'll qualify that in a timeline that is somewhat undetermined. So I agree with Mark that high touch is not going to go away. There's going to be aspects of high touch, but it doesn't mean that that instrument to me is not going to be digitized, right? And having that efficiency, particularly, you know, again, I'll harken back to Lawrence's comments this morning on the size of our bond market and how much of it is not traded, right? To be able to move those to a digital asset framework brings transparency. And there's friction because there's lots of legacy protection of why there is high touch, right? We call that margin, right? And the more transparency and information that you put forth into the system, we see that compression. We've seen that in virtually every asset class, if not every asset, that's gone from phone brokered to a hybrid electronic model, to algo to high frequency. And what happens over time? Margin compression. You know, when I was trading equity back in the day, it was 6 cents a share, right? After we went from fractions, right? We're talking about 20, 30 mils. You couldn't imagine that compression of spreads. So I think we do see similar attributes as this space all moves to digital.
The camera team doesn't like that answer. They zoomed back out, so we're going to fix this. I appreciate you guys helping me screw around with them.
Just get it straight on Pomp's face, just right there. Get him a one shot.
We'll be in a lot of
there.
trouble then.
Ta-da.
We have 5 minutes left, so last question, and then maybe we'll have some time for questions. I don't even know if we're allowed to do questions, but we're going to do them. What type of asset gets tokenized first, or is most important to get tokenized? So there's 4 assets: stocks, bonds, currencies, and commodities. Do we see stocks, bonds? Is it something else? Just walk me through how you think about the different asset classes and kind of what comes first and what that sequential evolution looks like.
Private securities, private stocks.
What was it?
Private stocks.
Why?
Because it's the most broken marketplace. It has the least digitization, the least use of technology tools.
No pressure. No
Look
pressure.
at that, see? The least use of technology tools and the most pent-up liquidity that would benefit people is in that marketplace.
All right.
I love this. I'm going to have to disagree with Mark again. We can't be partners anymore. I do think private securities, private company securities are version 2. I think what is the lowest hanging fruit are these large, chunky assets that are in the marketplace today. Let's talk about how do we innovate around real estate. And again, we'll sneak this one and tease it out a little bit. Templum's going to be issuing close to a $600 million offering in the next 30 days. Existing portfolio triple net lease, right? Having a yield instrument that is higher than market standards, that's going to have a pathway to secondary liquidity. Not a heavy lift, right? You're bringing transparency and a pathway to liquidity to an existing asset. Let's talk about asset-backed securities. Let's talk about any kind of debt instrument, credit instrument that has yield, that are lower hanging fruit that's already in the marketplace that needs a pathway to liquidity and transparency or symmetry of information. I think private companies, tremendous need for all the points that Mark needs, but I think we're going to see some friction in the adoption because many private companies don't want to display their information early on. So I think they're going to have to get more comfortable. And listen, we've been chasing the private company mantra for a while, but I think that's version 2.
Have you told anybody about the $600 million? Is that the first time you ever mentioned it?
I think I slipped publicly.
I just tweeted that $600 million coming on Templum.
Yeah.
All right. Are there any?
That is a regulatory compliant slippage of a signed deal and in the phase of perhaps pre-marketing. So yeah, we're quite excited about that, and I think that'll be a very healthy offering for the entire ecosystem. We're looking to collaborate, syndicate, and again, this throws back to I think how we see the space, right? Many people in the room who are newer to the space didn't know what a syndicate was, didn't know what the left side of the book and the right side of the book is. So I think we're going to look to modernize that with distribution partners, syndicate partners, and secondary liquidity providers.
All right, we're going to take questions. Blockworks Group is so good. Look, on cue, they knew they had no clue I was going to ask for questions, and they already have microphones out here. So what questions do you guys have? We have 2 minutes, 120 seconds. James Radecki, sitting in the front, is going to ask the most ridiculous one.
Not ridiculous. The big topic for these types of assets, whether it's private securities or the chunky ones, is you can get people to go in and buy the first time. Where do you see the true secondary market coming from? Where does price discovery come from so that when people go to sell these back, they're not selling them at a deep discount? Who is going to provide that price discovery in the security token world?
Trading on a
hold
regulated
on. Before you answer, I've never heard the word chunky asset before, but that's going to be a new standard in Wall
It's
Street.
coming from
All
a
right,
chunky guy. It's insistent.
All right, go ahead.
Look, I can answer it the way Templum approaches the space. So it's really about transparency. So if we start from bridging our traditional markets to digital, right? The S&P CUSIP, why is that important? The standard bearer in the marketplace, 10 million CUSIPs for our publics. We're mirroring that to say, in order to get a CUSIP identifier for a primary issuance or a secondary on Templum, you have to go through this process. That means standardization of information disclosure now makes that instrument discoverable on Bloomberg and Reuters terminals globally. You change the visibility of that instrument to start. Well, then if you think further, what does the CUSIP do? It allows for much better settlement and process and less breakage because you actually understand what you're purchasing. So if we put that on one side over here, the pathway to liquidity. So we move the ATS from being a dark pool traditionally to being a lit pool. What does that mean? Full bids, offers, depths of markets, the ability to do indications of interest on a 24/7 basis. So there's multi-layers to our liquidity, and I say, as the process goes, and again, I throw this out all the time, people talk about early innings. We're not in early innings, we're still building the stadium here, right? So you continue to innovate. So the Templum marketplace allows for market participants to negotiate directly to come to price discovery. We are an ATS, so we can actually, versus being an aspirational player, we're fully registered, so we can match offerings on the system. And then I think thirdly, which has been really the interesting part in the last few months, is liquidity providers who are typically been market makers in the old model of specialists who are coming and saying, aha, these are institutional caliber assets that represent a level of tradability. There's new margin here that we don't have as we wrung it out in these existing. So we believe these liquidity providers that are signing onto the system are going to be a big component of this evolution of liquidity, not to be mistaken with public market liquidity today. Just to be clear, the pathway to liquidity, the visibility, and this little thing, and I get made fun of all the time when I say this, wonderful thing called social media, right? The ability for the first time in US history, given the Jobs Act, to advertise private securities for sale. So you begin to change the visibility of those instruments, which we think over time leads to better liquidity.
What he said. Exactly what Vince said.
It was such a good answer, we only got one. All right, we're out of time. The timer counted down to 0 and then started counting up, which makes me think we could stay here forever. But before we get up, can you guys please give them a thunderous applause, because my grade on this is how well you guys clap.
Thank you.
All right, thanks guys.